Thank you. Thank you, Jason. Thank you, Eric, for having me. So the presentation I'm bringing to everyone today is deploying AI in mobile first, customer facing uh, financial products. And it's a topic that's dear and near to my heart since I spent quite a few years in this industry. And I think the most important takeaway is this tale of two particular cycles. And I'll go into exactly what they are. Um, so now, but before we go into that, there is some really timely thing that's happening this particular year. Is this digital surge behind the current pandemic situation? We're all attending this conference online this year because of the pandemic. And there is this digital surge where customers are moving away from the offline type of financial services uh, in physical locations in droves. Just last week, there is this article by The Economist that reported that mobile banking traffic rose by 85%, and online banking registration rose by 200% in the month of April at the peak of the pandemic. And if you look at the total market, about 28% of the total market value of the top 500 financial institutions are now from non-bank entities. And this is up from just 19% last year. So, and as recent as last month, there is this one company, Chime Bank, here in San Francisco, which is an online-only bank, a neobank, that has raised almost $500 million, $485 million, at a valuation of $14.5 billion. This is huge in the industry. And with all this renewed interest in the digital platform for banking, for online banking specifically, what are some of the AI innovations and opportunities behind this trend? So this is the specific topic I want to bring to people today, bring to us today. And when we're talking about fintech, financial services on the internet, um, we have to remember that fintech or financial services has existed for thousands of years. So if you look at the historic record, it goes back to the Babylon times when the grain seed were lent out in the spring and repaid in the fall. So on the societal level, financial services is really used to direct resources to the places where we can create the most value. And at the individual level, for us using financial services, these incentives are usually can also be used to nudge and reward our own behavior so that we can form good financial habits. And the emergence of mobile internet and the internet in the past few decades really gave us the capability to architect just the right technology stack such that the incremental cost of serving an additional customer is trending to zero. So this allows us to really democratize the availability of financial services. Now, in this particular talk, where we want to explore the frontier of the application of AI in consumer finances through two particular cycles that's really important in this industry, and also looking at the mission and how the opportunities are there in AI to be able to help us move towards those mission more with higher speed and higher velocity. Before we dive into the specific topics, I'd love to also give a quick intro of myself. I spent a lot of time at Carnegie Mellon and Berkeley in my studies, and did some quantified private equity investment at Silver Lake, and led several data science teams here in Silicon Valley. For my work at Simply Hired, a job search engine, I was also invited to the White House Office of Science and Technology during the Obama administration to advise on data-driven product and services for addressing the unemployment for the state the state governments. And also more recently at Yiren I was part of the executive team that took it public, which is it's the first peer-to-peer lending company to go public on the New York Stock Exchange. And at the same time, like I see gaps between where industry is and where academia is in preparing people for a career in data science. So I also teach a class at Tsinghua University on online credit risk analysis and fraud risk analysis, and recently wrote the book on becoming a leader in data science. And in this process, I was able to meet a lot of great professors and leaders in the field. And they have taught me a lot about looking at the fundamental grounding in different industries. And if you look at the fintech industry, really it's providing service in three fundamental areas: saving, lending, and transferring. And with the emergence of new technology, like the internet technology, as well as mobile internet, as well as AI, uh, these technologies are being applied to facilitate the democratization of personalized finance in these three areas in different ways. And at the beginning, this is in really simple business models like information hubs, like forums for wealth management, um, and eventually, like recently, it's been used for a lot more complex business models, like the peer-to-peer lending, like the neobanks, where they're providing services in all these areas: savings, lending, as well as transferring, and combining those to be able to provide really attractive product and services. But how do these companies survive, right? How do they survive and flourish? Really, we're talking about the two cycles: the customer acquisition cycle and the customer sustaining cycle. And the latest trend for these is that because mobile internet is saturating, like pretty much everyone has a cell phone, a smartphone now, the amount of users that you can just go through your customer acquisition pipeline as a pipeline, like going in from the top and coming out at the bottom, is saturated. So what we need to do is to be able to invent new ways for doing online customer acquisition that is more efficient and not just passing through the small percentage of customers who may be the valid customer for particular banking service, but helping more and more customers, well, having portfolio of products and helping more and more customers. And then we're also seeing that the customer sustaining process is becoming more and more challenging. And there, we are looking at how companies are transitioning from a transaction-based process, like getting a particular fee for a particular service, to more of a relationship-based engagement, like a subscription fee, like rewards, to promote better use or more frequent use of a particular product or service. So, what are the opportunities in machine learning and AI in these cycles? Well, first, for the online customer acquisition cycle, the goal is really to lower the friction to transacting with a particular product and service while improving the user experience. So there are three areas of innovation in this process. You have the data source innovation, precision conversion, as well as exhaust data utilization. And in the financial services business cycle, the goal is to ensure the sustainability of service. And in this case, you first need to ensure that the business model is profitable and that there is self-protection for the business entity, like anti-fraud, as well as maintaining long-term trust with the customer. And with these two cycles in full swing, you can foresee your business improving. So let's look into these particular two business cycles and look at where are the AI opportunities within them. So first, let's talk about the data source innovation. So basically, with the mobile device, we have a gold mine for customer acquisition in internet finance field. We, you know, each of us is likely to carry around our smart devices every day and everywhere. So it's got a unique device identifier. It's got a phone number. It records the IP addresses we use, as well as the locations we've been to and the account information we use to log into devices, and of course our contact in the phone book. Now, these devices are like a digital passport that's continuously logging our traces in the cyberspace as well as a physical space. And if when we trust a financial service um, service provider, we can authorize the sharing of a portion of this data so that we can get better user experience, a smoother and more personalized experience. But of course, we are also conscious of our privacy, and we don't give out those information for no reason. So businesses have to really offer a attractive set of features in order for to be able to get those information. So what are some examples here of using AI and these new data sources to be able to provide new services? Well, back in 2017, the Bank of America launched the alert-free fraud detection capability, where without having to call your bank before you travel to a foreign location, you can turn on location tracking so that it will just ping the Bank of America app once a day to verify that you're near your Visa card swiping location. So you can avoid credit card declines when traveling. Now, that's a good, convenient service, but it serves a pretty narrow range of customers, and there is a pretty big trade off in giving up your privacy for that purpose. Well, more recently, there's this company called Empire, which is a provider of O2O, offline to online, or online to offline, card linked offers. It provides a network of local discounts for consumers, and that's really simple to use. And in exchange for that, when you're looking for the local discounts, it will be able to get your local location to, and so far, they have over 250 million cards registered with this service just because people can actually get real bang for the buck. Like they can get real savings for giving out where their location is to find nearby discounts. And further, there is this company called Earning that has this function called Auto Magic Earning. So Earning is a financial platform that allows people to get an advance on parts of their paycheck that they've already earned before payday. And for many people living paycheck to paycheck, being able to get a little bit more advance, their paycheck a little bit more in advance, it can be a huge benefit. And what it does is it checks the user location to make sure that they have been going to work and to minimize the check advance risk, to be able to provide this check advance with very low cost. Essentially, they don't charge anything for it, only depending on some tip afterwards. And they're able to provide this service, and many people are happy with the trade-off of giving up their location on a daily basis in order to get that service. So these are the kind of examples where, in order to get the data source, in order innovating, getting new data sources, companies are using very innovative product designs to be able to get to those data sources. So that's the first type of data source. The second, the first type of innovation. Let's talk about the second one. The second one is what I would summarize as precision conversion. So we talked about earning. There is also Acorns and Mint that are quite innovative companies that are doing precision conversion. Acorns is the neobank that acts like a little piggy bank for with investment capabilities, and it's already got over 5 million customers starting to invest with Acorns. At Mint, it's a personal accounting service app that can help monitor one's net worth across many different asset categories, and now it's wholly owned by Intuit. So for these kinds of services, they actually target quite different customer base. So for earning is people who prefer whose preference is towards spending, and for Mint and its preference towards accounting, and at Acorn for Acorns is somewhere in between. With these customers, they're able to get streams of information from the basic service they provide with linked accounts. And with this continuous stream of people's financial data, what we can begin to gain an ability is to understand how people are conducting their financial lives. So we can actually see hints about whether people are dating, whether people are getting married, are they having kids, and we can anticipate over that time and over those sequences whether they may be open to purchasing insurance, life insurance, for example. So if we can anticipate people's need for financial services or general products, then we can begin to introduce those information to them right before they're needed, right at the time when they're needed. So there is some success cases in different fields for this anticipating trends type of capabilities. For example, at MIT, there's this billion prices project, where the project is collecting online prices from many countries around the world to compute those countries' real inflation index as experienced by the residents. And with this time series of data that they have collected, they were able to observe and then later anticipate how fluctuations in oil prices are triggering fluctuations in transportation costs and fluctuations in essentials like the cost of bread. And then there are also other interesting cases where it's from Alibaba, the largest e-commerce portal in China. There's this subsidiary and financial where there is this customer DNA project where it's extracting relationship between the various types of customer spending on Alibaba's diverse e-commerce websites. So one of the findings they had was that there was a close relationship noticed between tight clothing purchases and cell phone screen repair purchases. And based on this finding, Ant Financial actually developed a cell phone repair insurance product or warranty product and marketed it to people who purchase tight-fitting clothing, where their cell phone may fall out of their pockets more often. And the product is getting really good traction. So these are just examples of how we can use sequences of financial transactions to notice these interesting trends and find whether there are these inflection points in people's financial lives. So there's this blog by Andreessen Horowitz in 2016 about using inflection point to overcome fintech startup distribution challenges. And it defines the inflection point as triggering points in people's lives, like a milestone like graduation, or a point in time, like when people are immigrating to United States, or a micro moment, like making a first big purchase, like a house or an appliance, etc. And if financial services can identify and target these kind of customers with relevant offerings, they can achieve much lower customer acquisition costs. And even when the customers may not be looking for a new financial product at that time, people found that at those particular inflection points, people are more open-minded about trying new services. So with these capabilities, we can really leverage how to figure out how to take advantage of these streams of transactions and look at conversion, precision conversion in the customer acquisition cycle. So that's the second opportunity. Then let's talk about the third opportunity, exhaust data utilization. So exhaust data is the data collected but not used in the primary business model. And the primary business model for many neobanks, for example, are the subscription fees or the interchange fees generated from their issued debit cards. But in the data streams, the direct deposits are the most important transactions to track for these neobanks. But what about all the other transactions? Well, the neobank Acorn and Stash have both figured out ways to leverage these transactions to increase revenue and customer retention. So Acorns has this program called Found Money that rewards customers for purchasing through certain retailers. And retailers sees this as a way to build loyalty and goodwill with the customers by agreeing to invest some portion of those purchases into the user's investment account to improve the investors or the customers' financial wellness. So it's a win-win situation. And Acorns also get a cut of those money invested. With Stash, there is this stock back program where users can earn fractional shares of stocks, and by purchasing with the Stash debit card. And this increases people's engagement with both the debit card product as well as their wealth management product. So it increases customer retention. So these are just some ways exhaust data can help recoup some customer acquisition cost. And in recouping those customer acquisition costs and increasing lifetime value for customers, you can allow for more aggressive investment in customer acquisition at the front end. So those are the three different opportunities for customer acquisition. Let's also look at the opportunities for customer sustaining cycle. Now, in the financial service business cycle, one of the most important focuses is having a sustainable business model with a profitable business model. And in lending, for example, assessing customers' credit worthiness is pretty central to profitability. And the FICO score from the FICO Corporation is a really great example for such kind of models. It covers 5 domains of information like payment history, amount owned, etc. And to interpret these diverse data areas, you must go through a very rigorous model pipeline design. And there are actually 7 important steps in this model design: the credit risk and fraud, to quantify the amount of trust you can have for a particular applicant of a loan or a credit card. And these include recognizing the data sources, selecting which data sources to use, feature mining, feature assessments, incremental and imbalanced label management, and model strategy, as well as result assessments. And all these are parts of a rigorous modeling pipeline, part of a course that I teach at Tsinghua University for assessing credit risk. And when companies are using this full set of technology for assessing credit risk, it can improve the long-term profitability of your company's business model. So that's for profitability. And then there is also the area of self-protection. So for self-protection, it's really to protect against online fraud. Many online business models often involve producing transactions without face-to-face interaction with transacting parties. And this is actually making fraud rampant. And in online lending, for example, the loan amount could be on the order of thousands of dollars, and it could be approved in minutes, and the money could be transferred to the fraud perpetrator's account in a few hours. And once the money is transferred, there's really no hope to get the money back. So the role of AI is to increase the cost of fraud without interrupting the product experience from a normal customer. And there are three AI case studies that I can share here. One is the FinGraph knowledge graph that I created at Yiren Digital, which had over 260 million nodes, entities, and over 1 billion edges, and it's produced on the Neo4j graph database. And we were able to work with the fraud investigators to figure out the specific features to use to find rogue lending agents who are committing fraud. And we were able to stop the dispersion of about $30 million a year at the application submission time before the money gets dispersed. There's also a really great case with Danske Bank with their deep learning fraud model for credit transaction fraud analysis. They used a 6-layer residual convolution neural network to reduce the false positive rate by 10 to 100x compared to rule-based implementations. And PayPal is also a pioneer in this area, especially in combining the use of active learning and deep learning to significantly improve the fraud model performance, as well as reducing the human cost of labeling fraud data. So, AI techniques are especially useful in anti-fraud compared to credit risk analysis, mainly because the regulatory requirements for fraud analysis is much lower than credit risk analysis. So finally, let's talk about the last piece for establishing long-term trust once you have a profitable business model and you can protect against fraud. Now, there are multiple ways fintech companies may inadvertently become a service for the fraud ecosystem. Now, let's take a look at a real quick video to see how. And sometimes it's not, it may not even be very high-tech techniques.
So I invited a few of the world's best hackers to try to hack me and show me where my vulnerabilities are. And now I'm going to meet them in Las Vegas for DEF CON, the biggest hacker convention of the year. They're going to hack me using social engineering, which is essentially hacking without any code. They just use a phone and an internet connection. You want to do a sample of phishing call? What's phishing? Phishing is voice solicitation. And basically what you do is you use the phone to extract information or data points that can be used in a later attack. Let's do it. Who are you going to call? Maybe I'll call your cell phone provider and see if I can get them to give me your email address. I bet they're good. I bet they have my back. But yeah, go for it. I'm going to spoof from your number, so it's going to look like it's calling from you. Okay. Hi, I'm so sorry. Can you hear me okay? My baby, I'm sorry. my husband's like, we're about to apply for a loan and we just had a baby and he's like, get this done by today. So I'm so sorry. I can't call you back. I'm trying to log into our account for uses information and I can't remember what email address we used to log the account. The baby's crying and can you help me? Awesome. In just 30 seconds, at gmail.com, Jessica gets access to my personal email address. Now, if I needed to add our older daughter on our account so she could call in and make changes, how would I need to go about doing that? You would have to send me a secure PIN through a text message? Yeah. Well, the thing is, I don't think I'll be able to receive a text message if I'm on the phone. Oh, I'm not on there either? So I thought when we got married, he added me to the account. Jess uses my girlfriend's name and a fake social security number 5127 to set up her own personal access to my account. Wait, I'm sorry. So there's no password on my account right now? Can I set that up? She even gets the support person to change my password. Thank you so much for your help today. So she just basically blocked me out of my own account. I'll get her set after this. All right, thank you. Holy shit. So they just gave you access to my entire cell phone account. You're gonna have to go on and change your password now because it's Jess, my name. And all it took was a crying baby and a phone call. Yeah.
Yes, the security vulnerabilities may not be actually from your app, but sometimes it could be from your customer service department. And customer service departments are actually an increasingly important part of online financial services, mainly because that's an important connection between the customer to this online entity. And just this morning, Peter Voss has had a great talk about the current state of chatbot and the challenges there. Now, in recent years, there has been dozens and companies, chatbot companies, that's gaining venture capital backing. And one of them is, for example, Custodio, which is a personal financial assistant company that's funded by a core team from SRI, Stanford Research International. And it's got the prior track record of developing Siri, and which was sold to Apple. And AI, we can see, can play a big part in performing natural language processing and personalizing intelligent conversations with the customers. And they, most importantly, they can avoid human errors in violating customer privacy protocols when they're used. So with that, let's conclude. The financial systems we see today is enabled by our society's resource to be able to be more, to be able to allow these capabilities and resources to be more efficiently distributed. And our internet technology and AI can enable the marginal cost of serving additional customers to trend to zero. So we have the mission of democratizing of personalized financial services whenever and wherever they're needed using AI. And the two cycles we talked about are the customer acquisition cycle and the customer retention cycle. And the opportunities we see in there include the data source innovation, the precision conversion, and the exhaust data utilization on the customer acquisition side, as well as the customer sustaining side with profitability, self-protection, and building long-term trust with the customers. And hopefully, as we work together on using AI technologies for the mission for democratizing personalized financial services, we can work for the best financial interests of the customers. And this particular talk we have is really talking about, I'll speak briefly about my book. It's really talking about driving fundamental impact with deep domain understanding. And it's just actually one of the topics that I wrote about for the data science function director in the domain of expert knowledge. And in the book, we also mention how expert knowledge can be used for leaders in data science across different levels of leaders, like the tech lead leading a project, to a team manager leading a team, to function manager leading the data science functioning in company, to a company executive really inspiring an industry with innovations in the field. And expert knowledge is just one of 6 different areas we talk about in the capabilities for a data scientist in technology, execution, and expert knowledge, as well as the virtues or the psychosocial aspects of working in data science, looking at the ethics, rigor, and positive attitudes that's required to be successful in data science. So if you want to learn more about this particular topic or the book, here's some information. And for this conference, I worked with the publisher to get a discount code, 50% off discount code, and that's on the screen. And you can get to the book through the 2D barcodes.
Okay. Thank you. That's a great talk. And thank you for your offer to all ideas, members. Like I mentioned, at the beginning of this talk, so we know each other for many years. You started your career as a research scientist at UC Berkeley, and you got a PhD degree in computer science and engineering. And then you went to Simple Hire. I got the name of the company.
Yes.
I think we know each other when you were working there, and then you went to a P2P finance company, and then go back to school as a professor, and then go LinkedIn as the leader in the data science department. So okay, I have a couple questions. So the first is, we are under a special situation these days, the economic situation. So as I know, a couple months ago, many P2P finance startup companies in Silicon Valley, I know several of them shut down. And also last year, internationally, in China and some European countries, some P2P company, they were struggling, So what do you think the major reasons for the P2P companies, especially the startup, fintech companies, they fail? I know, you were working with, some of the companies. Just share your points, why the, P2P and fintech is, currently they are struggling, right?
Yes, absolutely. So I think to answer your question, the short answer is that there's some fundamental learnings from the experimentation in doing P2P with in an online form around the world. And the learnings different in different part of the world because of the financial system foundations in different parts of the world. But there are some that are consistent. So at the beginning of the P2P uh, uh, experimentation, the belief was that people can make the best judgment about who to trust and who not to trust, especially in the financial domain. And all the all technology needs to provide is a place for people to meet, right? The prosper and many initial business models allowed people to even set their own interest rate. What the industry realized as a whole is that figuring out whether to trust someone with your hard-earned income is actually not that easy. So the industry has shifted to a platform-assessed risk model. And Lending Club is the first success case there, where it's setting the interest rate, and all you need to decide as an investor on the platform is to say whether you want to invest at that particular interest rate or not. So that was a huge innovation that propelled companies like Lending Club and Yiren Dai to become public. But eventually, the company business models became a good way to find opportunities to give the people in need these personal loans, unsecuritized personal loans at a very reasonable interest rate. And there are a lot of institutions that are becoming interested in this class of asset. So you see institutions starting to come in, and they would really, demand much lower interest rate or much lower returns, like 4 or 5% returns on fixed income, asset class. So those particular levels of interest rates become no longer attractive to individuals, individual investors. So at the same time, like the industry changed from a technology platform, like a peer-to-peer lending technology platform, to basically platforms that can be really good at finding lending opportunities within a particular asset class. So it became a one-ended business model rather than a two-ended business model. And that changed the valuation on Wall Street for these class of businesses. So that's what happened in US. And in China, there is just a lot of companies that without the technology that is working in this peer-to-peer lending industry that's messing up the industry. And government regulation came down and forbid any companies to be doing this without a banking license or lending license. So, but you are actually seeing this particular business model flourishing in India, South America, Africa, and Southeast Asia. And there is actually a lot of need for these kind of lending product and services. And I see that the contribution of AI here is still trying to democratize access to capital for people in need at an interest rate that is reasonable for them.
Okay, yeah, thank you for your answer. I know that is a tough, question. So, okay, another question is, we were talking about, the user acquisition and also, how to keep the loyalty users in your products or service. So, for the graph computation, I mean, graph database, graph theory. So you mentioned a little bit, in your presentation. So can you give us, just one case to use the graph theory or graph, database or graph computation to solve a business problem?
Yes, absolutely. And I think there are some very valuable use cases with lucrative return on investment that we can use graph databases for. One is fraud analytics. So in fraud analytics, really for individual fraud, it's not that scary for financial institutions, mainly because the technology that can be gained from any one individual is relatively low tech, and it's relatively easy to detect. But what financial firms really are scared of is the organized crime unit in financial fraud. And but while each one of their perpetrated fraud is hard to stop, you can actually see a lot of patterns in how fraud is being committed, mainly because the fraudsters, luckily, right now, is still a pretty small community, and they leave traces in the devices they use, the methodologies they use, the document they use. So what we were able to do at Yiren Dai was build a knowledge graph where we can actually see the second degree, third degree connections of applicants. And many of us may be familiar with the sixth degree of connectedness for how people have just interpersonal relationships. And actually, like within the past decade or two, with social networks, is no longer 6 degrees. It's like somewhere between like 3.4 to 3.6 degrees of like us, and the average degree of connectedness between us and anyone else in the world. But for fraudsters, they actually have an even smaller community, and their degree of connectedness, the average degree, is between 1 and 2, 1 point something. So graph databases are actually amazingly useful in figuring out those tightly knit networks and finding those interconnected fraud networks so that we can root out the highly suspicious applicant that has a lot of connections to previous applicants. And that's actually one of the main ways that we were able to save $30 million a year in avoided fraud losses. And large companies like Alibaba and Tencent, of course, they have even more sophisticated technologies. Today, there's even deep embeddings for graph structures called graph embeddings that can be used to detect even harder to detect patterns in graph database and graph connections.
Okay, thank you for your answer. I do have some other questions, but I would like to turn the radio to Iris, our session chair today, to take care of the question from our attendees.
Yeah, of course. So thanks for sharing. And we have lots of questions. Let's begin with the first one. Jake, can you speak to any regulatory issues pertaining to the use of AI in financial service?
Yes. So the regulations are different in different parts of the world. And in US, there's a Fair Lending Act, as well as many other regulations governing what features can be used and cannot be used in credit risk analysis. And there are like very clear regulations in that aspect. But for other areas in fintech, for example, in fraud analysis, there is much less regulations because it's really the protection of the viability of financial systems and services. And in privacy, from the privacy aspects in Europe, for the privacy regulation, it requires financial models to be explainable, and so that you can provide simple explanations when, for example, you're declining someone's credit application or loan application. So for that, there are different ways where you can use locally interpretable machine agnostic explanations, the LIME approach, and other type of approaches to have a locally linear type of explanation for complex models. And people have known, for example, the Danske Bank deep learning model used LIME to be able to provide those explanations for its fraud models to be able to go online in Europe.
I see. It seems like it's related to the region, right?
Yes.
Yeah, I see. And there's another question about the region. So how can this highlighted AI approach be optimized in sub-Saharan Africa and other global south regions?
Yes. So I'm not the best person to talk about that, but from my reading of related topics, what I read about is that Sub-Saharan Africa and the Global South regions, they are also progressing very fast in the democratization of the mobile computing platform, the cell phone networks. And there are companies that specializes in first extending credits for cell phone bills to be able to assess and collect data for and assess people's trustworthiness in being able to pay back any particular credit or loans. So for the AI approach, it's really about what is a platform that we can use to collect data about people's behavior and how to be able to use these platforms to identify who you're working with so that these platforms will not become a hotspot for fraudsters where they would buy off trustworthy people's cell phone and be able to perpetrate fraud on those devices, right? So it's really about identity and being able to assess people's trustworthiness on the accessible platform to be able to use AI to be able to extend additional services, either financial services or perhaps other services to those regions.
Yeah, I see. So let's go to the next one. So what particular social economies problem can more fintech startups think about solving using data science? So it can be lots of cases. Could you please give one or two examples?
Yes. So there is the uh, cases that's more close to home in US, and there are cases that's further out around the world. So around the US, there are actually still a large proportion of people who credit agencies consider thin file or no file clients. There's about like 10 to 15% of those people in United States who find it really hard to access the financial systems because they do not have loans that they've used or do not have credit cards with the financial system. So for this group of people, there are a lot of capabilities that a lot of startups that are working on how to bring these people into the financial system so that they can enjoy the benefit of the financial system, like being able to transfer money very cheaply or free, and be able to have bank accounts without paying huge overdraft fees when their account balance goes low. And the wave of neobanks, the like of Acorn, Stash, Varo, Chime, all these companies are working in this general direction. Further out around the world, there is the financial accessibility of people who may only have a cell phone and no bank account. And even in relatively developed parts of the world, like in China, there are like over half of the population who don't have the as much banking access as many other people. So um, there is actually huge room to improvements to democratize access to financial capabilities through mobile smartphones to be able to help them lead better lives.